I wasn't even recording. It wasn't even being recorded all this time. Okay. Peter. I think Peter is having some connection issue, connectivity, and I think this one person joining must be Peter. Oh, Mamadou. Okay, it's Mamadou. How are you, Mamadou? Um, and so we are back down to 2 people again. I wonder what Peter is it? Jiaming is now joining. Okay, how are you, Jiaming? How are you? So Peter needs to, I think Peter has connectivity issue, but let's see. So we have basically uh, 2 people on the collaborate and 2 people on the discussion board. But if you're in the collaborate and haven't signed into collaborate, please do it now, because that's the only you shouldn't forget to do your attendance, right? This is the only physical proof of your attendance. Jorge has joined us. Please sign into discussion board if you haven't done it yet. Mamadou and Jorge, please sign into today's forum. Okay. I will check back on this. Okay, I'll check back on this later. And also, in the meantime, I would like to take your attention to you may have noticed, right? Over the weekend, you may have noticed the test results have been updated as with the attendance as of 11/24. Quiz 1, midterm and quiz. And you know, after every exam, I update the statistics. Okay, so if you open that file, if you download and open that file, now I have these 3 sets of data: quiz 1, midterm, and quiz 2. We will still need, final, and the average, weighted average has been updated, of course. Now, the weighted average is as it was set forth in the syllabus, and as I have emphasized on multiple occasions, is 20% of quiz 1, 20% of quiz 2, 25% of midterm, 25% of final. Okay, and then attendance is 10%. In other words, attendance is attendance and participation, basically. And you get attendance, maximum of the attendance is 5 points. And the other 5 points are supposed to be filled by participation. But I've been telling you, participation points have no limit. Right? You remember that? Because from the day one, I said it's also fully detailed in the course information that every attendance, each attendance is 0.165. Okay? 0.165. You guys are section 1400, so take a look. August 26th, this person was absent. August 31st, present, right? Absent. And August 31st, this person earned 0.25 for giving me an average answer, right? So this all tells, whether you were present or absent. This person has total of 4 absences. Total of all those points are 3.729. And as I said, if you earn 0.167, per each attendance. And if you're late, you don't even on this. If you're late, you get 0.056. Okay? Now think about it. One semester is 15 weeks, and we meet twice a week, so there will be 30 sessions. There are 30 sessions per semester. So if you attend all those 30 sessions, there will be close to 5. It will be like 4.99. It will be like, 5 points. And the other 5 points are filled by your participation. If you never participated, you only have 5 points for this, right? But if you have participated in class and gave me great answers, let's say if you give me one great answer, that's 1 point. One average answer, one good answer, that's 0.5. One average answer, that's 0.25. So if you have given me like 30 great answers throughout the semester, that means one great answer per every session. If you gave me one great answer over 30 sessions, you will earn 30 points, which will be then with the attendance. And if you've made, a perfect attendance, there'll be 5 points. There'll be 35. Total will be 35, right? So there is no upper bound. There's no limit. There's no upper limit in the participation points. And if that was the case, then here, suppose this is sorted. You can see this is sorted in weighted average, right? In descending order. Some people haven't done. Someone like this. This person missed quiz 1. Quiz 1 is 20%, right? So if this person, even if this person got 100, that's only 20%. But suppose this person got like 35 points for attendance, 35 points. And it's not going to be scaled because it's already, based on that 10 points, right? So it's already, based on that 10 points, right? So this 35 points will just enter as 35 points. It's not going to be scaled down. So then with this 35 points, it will more than offset. Will more than offset this 0, right? It will definitely then, think about it. It will be at least like like 20 points, 25 points above this, right? In other words, 10 points attendance by 35 points, you have already hit 10 points for attendance and participation, and that residual 25 will come into make up for this, more than make up for this, right? You understand? Any questions so far? Any questions? All right. So let me keep going. And if you have, and this weighted average has, look at the head count, 58. 58 people are included. It means, to this, weighted average was calculated by including the data all the way to this. Why? At least this person submitted one exam, so it is included in the weighted average. And below that, these people are not included because they haven't done anything. They haven't done anything. So in this weighted average, the lowest minimum was 12.8. Maximum was 67. The mean of the weighted average is 39, almost 40. So what does that mean? So if ND standard deviation is like 16, almost 17. So let's say um, one standard deviation above the mean is the cutoff line for A minus. One standard deviation below mean is the cutoff line for B minus. So there is no letter grade just yet because think about it. It's not complete until I get the final data. And once I get the final data, weighted average will change, right? It will change because now at this point, this is blank, right? So that, E2 is blank, which is, which has 25%, right? Which carries 25% weight. And the total attendance point will change. So everything will change. After the final, everything will change. So mean of the weighted average will change, standard deviation will change. But let's say based on the results so far, in other words, based on the weighted average as of November 24th, right? One standard deviation above mean will be like 46. I mean, 56. 56. So roughly, people here from this row and above get at least something like A minus. And of course, if you are like, then some people here, uh, something like above 60, will get like A. In other words, that would be like 1.25 standard deviation above mean. Okay. And then one standard deviation below mean is the cutoff line for C minus. So one standard deviation below mean will be 40 minus 16 will be like 24. 24 is like, okay, here. This is like, so below this, that's C minus, then below that would be like D plus and below, right? So, and of course, this criteria will change. It goes without saying, because final is still missing, right? Once I get the final, then this will change. This will change. Mean of everything. Mean of weighted average will change. But then, if you then if one standard deviation below mean is like that's the cutoff line for C minus, then what would be the cutoff line for B minus? B minus will generally, I give B minus, median grade will be like B minus. So in other words, usually not this, but yeah, that will be, so let's say mean is 40. So usually I use like, 0.5 below mean, 0.5 standard deviation below mean, or 0.25 standard deviation below mean. 0.25 standard deviation will be like 4 based on this. And then 4 below, that will be like 36. So then somewhere here, this will be like cutoff line for B minus. Okay, and the people below B minus, then this what I do is, here's the column that says homework average. So what is that? Homeworks are chapter problems, right? End of the chapter problems on Connect, and end of the chapter problems are automatically assigned by the schedule, right? And there are So if you go to Connect, what chapter problems are due when, and those, if you have done all of those chapter problems, I use the average of all of that. Plus, remember, in the early part of the semester, we had ROI practice test, right? ROI, return on investment practice test. So I average all of them, ROI, practice test, and the Connect chapter problems. I average all of that. And I use it to bump up the lowest exam score. I mean, so people here, let's say, who are below 36, so that's below B minus, right? So if you have done all of those, I use that. And this person missed quiz one, then this is the lowest exam score. So I use the average of the homework to replace this. And for this person, I will replace that. For this person, I will replace that. Of course, assuming that they have done the final. This person, the average will replace that, right? The average of all the homeworks. And then, for example, this person got 0.25 in the midterm. And I will use the average of all those homeworks to bump this up. Okay? Either replace this or add to this. And in this case, this person has both quiz 1 and quiz 2 missing. Then it doesn't matter. I can apply to either one because they carry the same weight. They are 20%, 20%. If this person missed also final, then I will apply to final because final is the final carries 25%. It's more in the interest of this person to apply that to something that has more weight, right? In this case, I will apply to this because midterm is 25%, right? So rather than to quiz, I will apply to that. So in other words, that's all the more reason why you have to do you have to do faithfully all the chapter problems. It will spare you at the final moment. And what about the people that are above B minus? If you have done all the chapter problems, right, the reward, you already got the reward because doing the chapter problems will help you get better score in the exams. So you wouldn't have got, without doing the chapter problems, you wouldn't have got these scores, right? So basically, you got the reward. These people are rewarded already in the higher exam scores. And also, people in the, let's say, the cutoff line for A minus was 56. And let's say this person is marginally below 56, right? In other words, it's within 0.5 margin. Then I will round it up, right? So if you're marginally below the cutoff line, then, and if you're within that margin, 0.5 point margin, that such a score will be rounded up. Then you will be bumped up to the next category, bump up to the next category grade, okay? Next grade category. So this is how it's going to work. Again, so you got to do your best until the final. You got to do your best to all the chapter problems, okay? And there will be adjusted weighted average and adjusted grade. Okay. Any questions so far? Any questions? Okay. Any questions? It seems like there are no questions. Okay, then we're gonna move on to today's topic. I'm gonna close this. Move on to today's topic. And today's topic is bond valuation. Um, so we already know a lot about bond, but what we know about the bond is the uh, institutional aspect, because we talked about bond a lot in the first topic, right? In topic one, the second part of topic one is second part of topic one was the interest rate and macroeconomy, return on investment and macroeconomy. And then to understand more about the interest, there is an only bank interest rate. There, any debt instrument will pay interest. So a typical standardized debt instrument is bond. So we talked about bond a lot in the, uh, especially the institutional aspect of the bond, a lot in the first topic. And if you remember, so we talked about um, different types of depending on who issued the issuer, depending on the issuer who issued the bond, right? Who is the issuer? And I said there are three different entities that can issue bond. One, U.S. Treasury, the federal government, and then corporations, corporate bond, and then municipal bond, municipal, right? City government, state governments, city governments. And I told you also depending on the maturity, right? Depending on the maturity. Okay. Uh, I should have deleted this. And depending on the maturity, we have um, short-term and long-term bonds, and they all go by different names. Okay. Um, basically, the line between short-term and long-term is clear. Um, does anybody know what is the where the line is drawn? What's the demarcation line? What sets apart long term and short term? Hmm? Anyone? This is very easy, and this is your chance to earn extra points. Nobody can tell me. Okay, I see seven people, at least seven people, um, and nobody's telling me. Nobody can say what is the line between long term and short term? Anyone? What's the line between long term and short term?
I don't know.
Dexton, if you don't know, why did you turn on your microphone? I mean, just to say I don't know?
Because I thought I was gonna see a picture. Like usually there's like a picture like on the screen where I could try to figure it out. But it's like the attendance
Yeah,
thing.
then, here's the picture.
Okay. Now you said what's the difference between long term and short term? What?
Yeah, what is the line? Where is the line drawn between the long term and short term? Where is the line drawn? What's the line? Where's the line between long term and short term?
Hmm. I have no clue what I'm looking at.
Anybody else? Anybody else? Someone? What? 7? Oh, that's a question mark. That's 7 question mark. Any other? Look, the line between long term and short term is 1 year, right? Anything on the anything on the 1 year is short term. Anything above 1 year is long term. Okay. Well, please don't. I can't see it, right? I can't see it. Let me find a way. I have another laptop, so I can use 2 screens to. Let me. Okay. So here. You have to understand. I have only um, one screen, and then clearly that means I can't. So I'll have to use another laptop and sign in as a preview user. That is preview user. All right. So that's going to take some time. So let me continue. Yeah. And depending on, so the line between long term and short term is 1 year. Okay. So any debt instrument with maturity less than 1 year is short-term bond, and the bond is the word, the name bond. The word bond is the name, reserved only for long-term bonds. Short-term bonds have different names. For Treasury, right? The collective name is Treasury securities, and we talked about this, early on. Collective name is Treasury securities, and short-term Treasury security is called Treasury bill, right? And then long-term Treasury securities are called again, and there's a distinction. I mean, for corporate bond, short-term corporate bond is called commercial paper. So bond is not the name for short-term instrument. Short-term instruments are traded in the money market. And whatever is going on in the money market, it's not called bond. Bonds are basically long-term. So corporate bonds, when we say corporate bond, they have maturity longer than 1 year. Okay. And maximum is usually 30 years. I mean, there's no law that says bonds cannot go beyond 30 years, right? There's no law such thing. But generally, the investment horizon, right? The maximum normal maximum horizon, investment horizon is usually 30 years. That's why. And then municipal bonds, there are no short-term municipal bonds, right? All the municipal bonds are basically bonds. They are long-term, usually 30 years. And then Treasury, there is a distinction between Treasury note and Treasury bond. Okay, so then where is the line? Treasury note, obviously, the maturity of the Treasury note is shorter than Treasury bond. So where is the line? Where do you draw the line then? I mean, between short-term bond and long-term bond, the line is 1 year. Then between Treasury note and Treasury bond, where is the line? Where do you draw the line? Anyone? So this is a point giver, even, and we talked about this a lot. Well, I'm sorry, Eva, but I already said one, so you should, and if you meant to press one, hit one, actually, Jorge, 2 or more years. No, you were, Jorge, that was your answer to this question. Was that the answer to this question? Where's the line between Treasury note and Treasury bond? No, not 2 years. So nobody got this right. It's 10 years. Okay? Come on. You can, if you don't, if you don't remember, you can simply go back to, why don't you try to do that? I mean, this is something at least you can try. Go to, go back to course materials and go to topic 1, right? And open this file and, study again. That's what is meant by studying. But you just don't do that. In other words, you don't study, right? Doing that, digging it up, that's called studying. And that's also research. You're doing your own research. Oh, so, we did this before, so what was it like back then, And why, nobody even, it's not even a trouble. If it is a trouble, it's a very minor trouble, and nobody even does that. I'm just, I'm so disappointed. Okay, so the line between the Treasury note and a Treasury bond is 10 years. So a Treasury note has maturity between 1 and 10 years. Treasury bond has maturity between 10 and what? What would be the maximum timeline for bond? And I already said that with the corporate bond. What is the maximum timeline for the bond? Anyone? Still nobody. So you earn no extra points. I mean, I've been telling you so much, explaining as I showed you the latest, updated statistics, the summary statistics of the class performance. I explained how you earn extra point, and nobody is even, interested in earning extra point. To earn extra point, you have to do your work. Of course, you have to do your study. Look, I've been telling you the maximum timeline is 30 years. Right? Again, there is no rule. There is no rule or there is no law that says the maximum maturity of the bond must be 30 years. It can be there's no such rule. So you can have like 100-year bond, but look, 100-year bond is hardly, it's not very marketable. Sometimes they had 100-year bonds in the old days, especially during the war. Wartime war bonds had extremely long maturity, especially during the Napoleonic War. during the Napoleonic War, it was quite common to sell war bonds that had like 100-year maturity. French government, under Napoleonic rule, uh, issued, like 100-year war bonds. So even until like 1985 or something like that, there were uh, uh, Napoleon was exiled in, I believe, in early 1800s. Let me quickly. Uh, no, but there were some old war bonds dating back from even until 1980s. We could see some. It was rare. Uh, some war 100-year bonds that dated from Napoleonic War. So let me. Uh, that's not a anyway. That's not the. That's not a big deal. That's not the main focus of this class. So now we know. Now we understand. Depending on who is the entity, the issuing, who is the issuer, right? We have three different types of bonds, and depending on the maturity. But this is something we already talked about at early on at the beginning of the semester, right? And then so if you download, and I told you to download these files, and if you download this file and open it, right, the first page you see will be this. These are how bond prices are quoted in the print media, right? And in online media, it doesn't follow exactly this format, but basically, this is the basic format uh, in the print media. So there are three different, bonds based on three different issuers. The first one is Treasury, second one corporate bond, third one municipal bond, and in the second column, corporate bond and municipal bond are all showing coupon rates. Coupon is what the bond pays. Coupon is the interest that the bond pays. Coupon is the interest that the bond pays. Okay. So it's the interest rate, and the corporate bond was paying 7% coupon interest, CIT Group, and I believe CIT Group is in insurance business. They are basically insurance company, and that 7% means 7% of the face value, right? And what's the face value of the bond? Anyone? What is the face value of the bond? Now, again, this is this is the time to rack up some extra points. Please study. And so anyone, give me a second because I can't see. Let me open that. Well, I'll have to use it as a student or preview user. But I was trying to open another. No, that's the coupon rate of the Treasury, not the face value of the bond. Okay, 2.75 is coupon interest that the Treasury pays, not the face value of the bond. What's the face value of the bond? No, you don't have to be sorry. You can be wrong. It's just uh, um, uh, You just need to give the correct answer to earn points, right? Anyone else? Anyone? What's the face value of the bond? It seems like nobody remembers anything from the first when we did the first topic. That's so disappointing. I'm so disappointed. Look, face value of all the bonds are $1,000, except that's my voice being echoed back from my another laptop. Um, Face value is $1,000, except the municipal bond. Municipal bond has face value of 5,000. It's a different. That's the only thing that's different. Um, but all the corporate bonds and treasury, they all have $1,000 face value. Okay, and then that means they will pay 7% of that face value, 1,000. So annually, and interest rate is always annual, so it's 7% annual, right? So that's $70 a year. Okay, but then they pay semi-annually. They pay interest semi-annually. In other words, twice a year. Then it's going to be $35 every 6 months, right? Uh, but annually, $70. Okay, I gotta kill the volume on this other computer, so my voice won't echo. All right. And so think about it. In the second column, they gave coupon rate for corporate bond and muni bond. But for treasury, they gave coupon rate in the first column. And instead, in the third column, generally it's the maturity, but for treasury, maturity is in the second column, right? So there are a lot of things that are, that treasury is different from corporate bond and muni bond. And also look at the coupon rate of the corporate bond compared to the coupon, which is the interest rate that the bond pays. Coupon rate, treasury's coupon rate is, almost immaterial compared to the corporate and the municipal coupon rate, the lowest, right? And I said, municipal bond has face value of the municipal bond is 5,000. So think about it. This coupon rate is 4.5% of 5,000, which is, of course, not a difficult thing to annually. It's going to be 5,000 times 0.045, 225 annually. And if you have 1,000 of them, right? First of all, because of this high face value, Um, Generally, no, it's not for individual investors. It's generally institutional investors, uh, mostly institutional investors, buy municipal bonds because muni bonds. Um, Another reason is um, all this interest is tax free, tax exempt. You don't pay federal income tax. You don't pay federal income tax. Uh, and the state income tax, at least in the state that this bond was issued. Okay, um, so suppose you have 1,000 of them. That means you paid close to $5 million to buy 1,000 of them, and then interest alone is then 225K a year, right? And mostly, muni bonds are 30 years for, so for the next 30 years, you get 250K tax free for the next 30 years. And of course, individuals cannot mobilize like $5 million, but for institutional investors, it's an easy peasy thing, right? And look at the maturity. Uh, Maturity of this corporate bond is May 2016. For us, it's already in the past. But and also the maturity of this muni bond, and it's who issued by whom? New York City, New York City Municipal Water Finance Authority. So New York City government is very safe. Think about this. Um, Among the city governments, municipal governments, there is not uh, no other cities are as safe as New York City because think about it. Most financial centers of the world, the city governments, and most financial centers are the cities. Most um, leading cities in the world. And think about it. Most financial centers, the city governments will hardly default because the tax revenue they have always more than sufficient tax revenue from the thriving businesses in the city, right? Because it's the financial center. So the largest financial center in the world, um, uh, London is also, before New York City, London was the financial center of the world. But now it's New York City, and then second place is London, I would say second, and then third one is like Shanghai or Tokyo. The fourth one will be, so if Shanghai is number three, Tokyo would be number four, vice versa, and vice versa. And then the fifth place would be like Frankfurt, Germany. Frankfurt would be, and then after that, Paris would be the next. And then after that, Milan would be the next. So these giant financial centers, they will hardly go bankrupt. So they are very safe. Um, so this is pretty much, New York City Municipal Water Finance Authority. It must be 30-year bond because its maturity is June 15th, 2037. But then the question is, so when was this example taken then? When did they take this example? Um, I traced it back to 2010. How? Well, we know you can calculate n, right? Remember, if you can calculate n, you can calculate n and trace it back. Uh, So, and according to my calculation, these examples were taken in 2010. If they were, um, then at the time, this bond still had 6 years left to maturity. This bond has 27 years left to maturity. And this treasury maturity was February 13th. So at least more than 2 years left, right? More than 2 years left. Uh, and you might wonder, isn't it 3 years? No, no, no. When I calculated the month of the year when this was taken, it was around like May or June of 2010. So from that point on, it just had more than just about 2 years and a half left, right? To point. So now then think about it. Okay, so the maturity of this treasury was February of 2013, but then what is that N? What is that N next to 13? What that means is that indicates that this bond was originally born, right? This bond was originally born as treasury note. That N is a designation for note. So it was like originally 10-year treasury note. Okay, so here, so how many types of treasury bill, treasury notes, and treasury bonds are there? Actually, there are 1 month, 3 months, 6 months, 6 months, and 1 year, right? Treasury bills. For treasury notes, 5-year and 10 years. Treasury notes come in 5 years and 10-year varieties. So how many varieties? For treasury bond, there's I believe 20 and 30 years. And 20 years, 30 years. But look, this is an interesting thing. So 30-year treasury bond, when it was at time zero, right? When it was just born, it has 30 years left, right? It has 30 years left to maturity. And as time passes, right? Let's say 20 years have passed. 20 years have passed. Then how many years are left to maturity? 10 years. Once it has less than 10 years left, it is being treated like a treasury note. Although it was born as a treasury bond, now it's not called treasury bond, it's called treasury note because it has less than 10 years left maturity, right? And also the same thing. Once it has, so let's say 9 years have passed, and since it turned into Treasury note, 9 years have passed, then it's got only 1 year left. So once it has less than 1 year left, then it is being treated as Treasury bill, also treated as Treasury bill. Okay, so some Treasury securities are born as Treasury bond, but as time goes on, it turns into Treasury note, and as time goes on, then turns into Treasury bill. Okay, so um, that's why there is this N designation there, because when it has less than 1 year left, then it will be traded as Treasury note. But while it has, but then think about it, the coupon rate among the Treasury note, among the Treasury bills, then Treasury bills will have lower coupon rate, but this one will still carry that 2.75 coupon rate because it's a fixed rate, fixed thing on this bond. Okay, so obviously there will be uh, uh, investors who would prefer this one because of the coupon rate. But once it has less than 1 year left, then how many coupons can you collect? Exactly when you have 1 year left, you can collect only 2 coupons. 6 months, right? Every 6 months. If you have less than 1 year left, then you can collect only 1 coupon. So coupon rate isn't really that meaningful at that point. And the coupon rate and the yield are different things. They are yield is a bigger concept because yield is return. Interest is only part of the cash flow, right? In case of, think about it, bond or stock, there are two sources of cash flow. One is capital gains. The other one is the additional income, like interest or dividend. But in case of bond, interest is constant, right? Because it's by the fixed rate. Whereas in case of stock, dividend is not constant. It's uneven every time. It's different, uneven every time, because it depends on the net profit. So as the net profit goes up, then the dividend will go up. Net profit goes down, dividend will go down. So as opposed to the dividend, uh, as opposed to stock, this is the difference in bond. But anyway, we now understand, what coupon rate is, and how we can, where we can find the maturity. And then fourth column, take a look at the fourth column, which is, price. And this seems a little weird. Why? It seems kind of out of place, right? 91.735. So does that mean $91.73? I mean, rounded up 74 cents. But even if we interpret it that way, but still something's missing here. Why? How can it be? How can a bond that pays 7% coupon interest, 7% rate interest rate for at least 6 years, right? For the next 6 years, how can such a bond sell for $91? That's nonsense. That's a nonsense. Any rational person would find it just irrational and nonsensical. Why? Think about it. Coupon alone, interest alone, is $70 a year. $70 a year. And for the next 6 years, the total of all these interest payment will be $420. Isn't that right? Right? $70 times 6, 420. That alone is 420. And then, of course, then we must find the present value of that. We must find the present value. Must find the present value of that. And it's not the present value of 470, 420. You gotta remember that this is an annuity, isn't it right? Because you are getting $70 at the end of the year for the next 6 years. So it's an annuity. So you find the present value of annuity, present value of all those annuity payments, 77, 6 of those, 70. And then finally you get the face value, which is $1,000, right? And that $1,000 will be at the end of 6 years, right? At the end of year 6. So you need to also find the present value of that. But then think about it. Interest, $1,000 6 years from now, the present value of that alone will be more than $100. Isn't that right? That alone will be more than $100. And the present value of all those coupon payments, that alone will be more than, also $100. So how can it be, $91.73? It cannot be, right? That doesn't add up. So actually what this means is this is $917.35. Then why did they express it like this? It is not the dollar price, but it is the price in percentage, as percentage of the face value. It's the percentage of the face value. You understand? So think about it. 91.735% of 1,000. That will be $917.35. That's the only way. Right? So all the bond prices are basically quoted as percentage of the face value. And you remember, face value goes by different other names. It's not called only face value. But what are the other names of face value? Can anyone tell me? What are the other names for face value? Anyone? No one remembers that? Or is there no one in this room? Huh? Ashley, are you there? Ashley? Eva, are you there? Eva? Jamming? Are you there, Jamming? Okay, one person. Okay, Eva and Ashley responded. But then, Jamming, are you there? Jorge. Jorge, are you there? Jorge? Jamming's there. Okay. Jorge, are you there? Mamadou, are you there? Mamadou? Mohammed, are you there? It seems like we are missing
Yes.
Mohammed. Okay, good, Mohammed. So at least we are missing 2 people, Jorge and Mamadou. But among the people that are still here, Ashley, Eva, Jamin, Mohammed. Can you tell me what are the other names of face value? Hmm? What are the other names? Okay, you don't know, right? You don't know. All right. They are also called. Look, I've been doing the telling you from the first topic. Someone typed in something. Okay, yeah, EVA maturity value. Not just maturity. Maturity value. You should say maturity value. So EVA, you got 0.25. 0.25. What else? Anyone else? Okay. Uh, Fate. Oh, okay. You're welcome. Yeah, I just checked it on my another other laptop. This is face value. Okay, this means face value. Yeah, yeah. Face value is that was the question. What are the other names for face value? It looks like future value, right? But depending on the context, it means face value. Future value is the face value too. If you think about it, for the bond, right? At maturity is in the future, right? You get face value of 1,000, so that's the future value too. So face value is called also maturity value, also called par value, and it's also called redemption value. I gotta use my finger to redemption value. Why? Because the companies that sold the bond, so they are the debtor, right? They are the debtors. You are debt holders, and if you bought the bond, you are the debt. You are the creditor, or the lender, or the debt holder. And then a bond also bondholder, and they are the borrower or the debtor, and they will have to pay. They will redeem the bond. They will redeem their debt by paying $1,000. That's why it's called redemption value. So you must know all these names, right? But it's not some. It's not. It's not something you just memorize by rote, right? Rote memory doesn't help. But by understanding the context, it's not difficult to memorize this by understanding the context, because face value is what they pay you and maturity, so maturity value. It's also par value, because the par value of the bond is 1,000. If it is selling above 1,000, it's called premium bond. If it is selling below 1,000, it's called discount bond. It's par value, right? And it's also called redemption value, because that's what they pay you to redeem their debt. Okay, so uh, think about it. So the price is price is percentage. The price is the percentage of the par value, 1,000. So $917.35, and this means 97.57% of the par value. And what did I say? What did I say is the par value of the municipal bond? What did I say is the par value of the muni bond? Anyone? I just said it during this class, during this session. We calculated the coupon uh, payment by using that number. No, no, Eva, it's not 10,000. It's 5,000. 5,000. So then to find the current market price of the muni bond, you multiply this by 5,000. 5,000 times this will come to like 4,600 something, right? You can easily find. Now, that's we haven't completely finished this, but that's all the time we have for today. So I'm gonna have to I'll have to say, I'll have to call it a day. Any more questions? Any more questions? No, if there are no further questions, I will see you guys all on. Okay, you have a good day, Eva. Have a great day, great afternoon, everyone. It's snowy and cold, so keep warm. I will see you guys all back on Thursday. Okay?
I have a question.
Yeah, yeah. Who is this?
Mohammed.
Mohammed. Yes, yes. Go on.
Yeah, I want to know my grade. What's my grade so far?
Oh, okay. Look, I have already. You joined the class late, so
No, I
please
seen it. I
watch.
seen it.
You've seen what?
I seen what he was showing, the average grade and
Oh,
everything.
oh, oh, okay. So you mean
Yeah,
you saw this?
yeah.
There's no letter grade just yet. There's no letter grade, okay? Because
Okay.
letter grade can be determined only after the final, because I need to get
Final.
the final data, right? So, did you look up where you are? Where are you? What row are you?
What do you mean?
What
Oh,
row number? Give me the row number. Where are you? Like row
my
24,
my
row
my ID
25?
number.
Yeah, yeah.
I'm. Hold on. Let me check on my ID number. My ID number is 238.
You
Yeah,
look it up
I think
and
it's.
yeah, look it up and just tell me what row it is. Like row 28.
Got you. Hold on.
Hmm?
I think it's. Yeah, 28. I think
Row
two
28.
three
So
eight.
that's you.
Hold on. 238 31401. It's
Okay, let
26.
me do this. Give me your student ID. Give me your student ID.
238
238
314
238 314. Is that it?
31401. Not zero
Okay,
one.
after four, what are the digits after four?
01.
01. Is that it?
Yeah.
Is that it? Okay,
Yeah.
so let's. Okay, row 26. You're there. That's you,
Yeah.
isn't it? Okay, good.
Yeah.
All righty. Currently, you are. This is your weighted average, which is better. It's above, like it's like 4 point, like quarter standard deviation above the mean of the weighted average. So you're pretty much like in the B minus range. Okay,
Okay.
based on this. But again, it will all
All
change
right.
because depending on the final. And then you missed quiz one, so you heard me. If you have done all the chapter problems, then uh, average of that will kick in to replace this, and then the whole thing will change again. Okay, so just keep working hard. Don't slack. Do
Okay.
all the chapter problems, and then it will
Yeah.
definitely bump up your grade. Okay.
All right.
All righty. All righty.
Got it.
So
Thank
that's
you.
all right. You're welcome. All righty. I'll
Thank you so much.
let me stop sharing, stop recording.